What is the beta of an instrument? Beta is a critical financial metric used to measure the volatility of an investment instrument, such as a stock or portfolio, in comparison to the overall market or a benchmark index. It quantifies the level of risk associated with the instrument relative to the market, making it an essential tool for investors, portfolio managers, and traders seeking to assess risk and optimize investment strategies. In essence, beta indicates how an instrument's price is expected to move in relation to the broader market. A beta value is calculated through regression analysis, which compares the historical returns of the instrument to the market returns. The result provides insight into how sensitive the instrument is to market movements and helps investors understand its potential behavior in varying market conditions. Interpreting beta values. Beta equals 1. A beta of 1 indicates that the instrument's price moves in tandem with the market. For example, if the market rises or falls by 5%, the instrument is expected to experience a similar percentage change. Such assets are considered to have average market risk. Beta greater than 1 signifies that the instrument is more volatile than the market. For instance, if a stock has a beta of 1.5, it is expected to be 50% more volatile than the market. These instruments carry higher risk but also present higher potential returns, appealing to aggressive investors. Beta less than 1 suggests that the instrument is less volatile than the market. For example, a beta of 0.7 implies that the instrument is 30% less volatile. These are typically sought after by risk-averse investors who prioritize stability over high returns. Beta less than 0. Negative beta values are rare and indicate that the instrument moves inversely to the market. Gold and other safe haven assets often exhibit negative betas during economic or market uncertainty. Applications of beta in trading and investment portfolio diversification. Beta helps in constructing portfolios aligned with an investor's risk tolerance. Low beta instruments can stabilize a high-risk portfolio, while high beta assets may be added for growth potential. Risk assessment. By understanding beta, traders can predict how an instrument might perform during market fluctuations, aiding in decision-making during volatile conditions. Capital Asset Pricing Model, CAPM. Beta is central to CAPM, which calculates an asset's expected return based on its relative risk compared to the market. In conclusion, beta is a valuable metric for evaluating an instrument's sensitivity to market movements. It plays a vital role in risk management, portfolio construction, and strategic investment planning. By analyzing beta, investors can make informed decisions, balancing their desire for returns with their tolerance for risk.